So welcome everybody. We're going to get started with chapter 14 on the statement of cash flows. And this is going to be a full walkthrough of it in the indirect method, which is going to be cash flows from operating activities, investing activities, and financing activities under the indirect method. And then we're going to prepare a statement of cash flows, take a look at free cash flows, and also some more details on using the direct method with given a balance sheet and an income statement as opposed to a whole bunch of transactions in the accounting equation, which is in the first chapter, our first few chapters, we went through a statement of cash flows under the direct method and we had the accounting equation. But now this is going to be how the statement of cash flows is prepared in practice under the indirect method, because it's a much simpler way to do it with huge companies that have millions of transactions, and we can't use the direct method as easily. And so a review on the reporting of cash flows. The statement of cash flows shows all the company's cash inflows and outflows for a period. It has useful information about the company's ability to generate cash from operations, expand its current operating capacity, meet its financial obligations, pay dividends, and it also shows a lot about what the company thinks the future is like and how easy is it for them to raise capital to expand the business, or do they have too much capital and they're simply just returning it to shareholders? They're not raising any more at all. I mean, Amazon, for example, they're not issuing any more debt. They're not issuing any more stock. They're simply buying back shares and paying dividends. They have more cash than they know what to do with, and that's from operations. They're using that cash for investing cash flows. They're using it to pay back shareholders with share buybacks and dividends and things like that. And compared to other companies which may be issuing more debt and still paying some dividends, or companies that are in the startup phase and they're simply issuing shares, right? So it tells us a lot about how are they getting cash, what are they using it for. The statement of cash flows, it's really interesting because it's only related to the cash line in the balance sheet. It's not really related so much to net income and profit and loss, but it's a financial statement that the SEC and the financial standards setting organizations determined was so important that it's required that companies have a statement of cash flows to really see what's happening to cash. And it's also a lot harder for companies to hide things with clever accounting tricks in the statement of cash flows. It really is where you can figure out like what's actually happening with cash in a business from a financial and an investing perspective. And so there's three types of cash flows from or used for operating activities. And that's the cash flows from transactions that affect the net income of the company, specifically that affect the net income of the company. And the only sort of asterisk here is gains or losses from investments, because those would be from investing activities. And investing cash flows are from investments in non-current assets of the company. For example, long-term investments, acquisitions, property, plant, and equipment, land. And the only difference here is if a company's business is buying and selling short-term trading activities, like a hedge fund that's buying and selling things like every single day, that would be short term, and that would be the operations of the business. That's the activities that they're doing as a part of their everyday business. Whereas investing activities would be long term. For example, like a Berkshire Hathaway, like Warren Buffett buying Coca-Cola and holding it for 20 years. That would be an investing activity compared to a company that makes their money day trading. Coca-Cola stock, that would be an operating activity because it's a short-term versus long-term investing activities. But it's not going to be that complicated. Investing activities, acquisitions, property, plant, equipment, and then gains from sale of those investments. And then cash flows from and used for financing activities are transactions that affect the debt and equity of the company. So issuing more long-term debt, paying back long-term debt, paying dividends, paying share buybacks, issuing more shares. Those are all in the financing activities. And the cash flow statement is laid out as follows. We have cash flows from or used for operating activities, investing activities, and financing activities. It's always going to be in that order. So operating on top, then investing, then financing. Then we have net increase or decrease in cash, and then we also show the cash at the beginning of the period and cash at the end of the period. And on public companies' financial statements, I think they also show cash paid for income taxes because that can be way different than income tax expense reported on the income statement because a lot of times they're able to defer taxes, for example, by buying new property, plant, and equipment, expensing it all for tax purposes in the current year. But in reality, there's depreciation and there's all these things over many years for financial statement purposes. So the actual cash paid for taxes and actual income tax expense can be very different for tax timing differences, essentially. And so the SEC has companies report cash paid for income taxes as well. But this is the layout. And when you're doing the homework and the quizzes and the exams, it's really important that you tie out your cash flow statements. And I can't stress this enough. This is add up all of the cash flows. So generally, operating activity is going to be positive. Investing activities they could all be positive or negative, right? Cash flows from or cash flows used for. Cash flows from would be cash goes up. Cash flows used for would be cash is leaving the business. And you need to add up all of these three cash flows and you get net increase or decrease in cash and make sure that that is the same as the actual net increase or decrease in cash on the balance sheet. It's the ultimate cheat sheet to make sure that your answers are correct because if it's wrong, you're missing something. Or there's a positive where it should be a negative. And there's so many details in these problems and they're so big, it can be, there's a lot to miss. Let's put it that way, right? And so that is the best way to check your work is add up all the cash flows and make sure that net increase and decrease in cash ties to the balance sheet. But these cash at the beginning and end of the period, that will show up on the statement of cash flows as well. And once again, operating activities, inflows are from sale of products, providing services. Outflows is purchasing inventory, paying employees, paying taxes. Investing would be purchasing property, plant, equipment, or no, sale. So inflows from investing would be the sale of property, plant, equipment, sale of investments, and then purchasing new property, plant, and equipment, purchasing investments. That would be investing activities. That's like capital expenditures. That's when Amazon's building their new data centers or rental car companies are buying a new fleet of rental cars. And financing activities are inflows from issuing long-term liabilities and issuing stock. Financing outflows is paying dividends, repurchasing stock, and paying long-term liabilities. And the different categories of these inflows and outflows are so important because it determines how much cash is left to pay to investors for dividends, for share buybacks. And that's really what determines the real return of a business is how much cash can investors get out of it. And that brings us to a metric that's called free cash flow. And this is usually at the end, but I wanted to talk about it. And essentially, it shows the operating cash flow available after cash used to purchase property, plant, and equipment, which most of the time is investing activities, but it's just sort of investing activities, but only the property, plant, and equipment portion of it. And the reason that this is split out is because depreciation expense is a non-cash expense. So depreciation is not included in operating cash flow activities, and we'll get to that later. But for businesses that are very capital intensive businesses, free cash flow is a good metric of how much cash is left over for investors after cash flows from operating activities and then minus cash used to purchase property, plant, and equipment, which the reason that property, plant, and equipment is included in this and not just operating activities is because a business, it's necessary for companies to purchase property, plant, and equipment. Picture a rental car company. Most rental cars, they have them for 3 to 5 years at a rental car company. If they stopped purchasing property, plant, and equipment, they would probably go out of business in 5 to 10 years because they would not have any cars left. And so it's an essential part of the business. This cash used to purchase property, plant, and equipment is eventually going to be depreciation expense. It's not available to return to investors. And so we use this free cash flow metric to determine what's the cash actually available for paying back debt and paying dividends to shareholders. And then we also have a free cash flow ratio to sales, which is sort of a profit margin, but using free cash flow instead. And this is especially relevant in industries where maybe they have a lot of really old assets, such as a ski resort, such as a railroad. They're generating probably more free cash flow than they are net income because they had generally so much depreciation expense and not a lot of new capital expenditures, which means that they're actually able to return to shareholders more than their net income every year for that reason. And so free cash flow can fund acquisitions, retire debt, purchase treasury stock, and pay dividends. And that's really because they're generating cash flows from operating activities and they're not required to put it all back into property, plant, and equipment. And for each of these years, we can calculate the free cash flow by taking cash flows from operating activities, subtract capital expenditures, and we get free cash flow. And then we divide free cash flow by sales, and we can get our free cash flow percentage every year, which is slowly growing, and that's seen as very favorable because that means they're able to return more cash to investors. And so we'll go through it. I just wanted to go through a real world example too of a statement of cash flows before we really get into the nitty gritty on how to calculate this stuff, because I think it makes it a lot more real and relevant to how to analyze the statement of cash flows. And this is for Vail Resorts. They're the largest ski company in the US. I think there's Vail and Icon Pass, Epic Pass, Icon Pass. I don't actually know which one is bigger, to be honest, but Vail is the public company, so we can take a look at their financial statements and snoop around. And they own many ski resorts, including Afton Alps here in Minnesota. And as you can see, so they have cash flows from operating activities. It starts with net income, which is about 300 billion. And then depreciation was 296 billion. And this is the indirect method. We'll go through this in a moment, but this is a preview of how the indirect method works. We take our net income and then we reconcile back to what is the actual cash impact to the business. And depreciation is not a cash expense, so that gets added back to net. We start with our net income and then we have to add back depreciation to come to our operating cash flow. And we also show changes, other non-cash expenses like deferred income taxes, stock-based compensation, those are non-cash expenses. Gain or loss on disposal of fixed assets is an investing cash flow, not part of operating cash flow. So we have to take that back out of net income. And then other non-cash income also changes in assets and liabilities. We'll go over that too. For example, if accounts receivable goes up, that's no impact to the net income of the business because of the accrual method of accounting. However, that means if accounts receivable went up, we did not receive that money from our customers. And so that's less cash flow for the business. If inventory went up, there's no impact to net income. But our cash flow went down because we had to pay cash flow to purchase more inventory. And so then we have cash flow from operating activities of 554 billion. They had capital expenditures of 235 billion. So their free cash flow is about $320 billion. And that's fairly consistent every year. They seem to have about the same operating cash flow, free cash flow, capital expenditures are around the same every year. But then we noticed under the financing activities, they had proceeds from borrowing new notes. So they issued a new, this year, 5.6% note, a few borrowings under lines of credit, which is essentially just a fancy credit card with a bank, except the interest is usually incredibly low because they're huge companies, something like 5% in these current rate markets, variable rate. And so they issued a bunch more debt, and then they paid out dividends of 328,000, which is coincidentally the exact same as their free cash flow. Companies know this. They know what their free cash flow is going to be about every year, and investors treat dividends as a promise. If a company cuts their dividend, investors are not happy. It shows like a lot of weakness in a company. If they cut their dividend, they really try not to, and they also try not to declare a dividend that they know that they're going to have to cut later, unless that's communicated to investors. Unless they're like, okay, we're doing really good this year. We're probably not going to do as well in the future, but we want to have these dividends now. That would be communicated, but the slow increasing dividends, those companies, the dividends essentially match free cash flow. But interestingly enough, we can see that Vail is also buying back shares of 270 billion. And where did they get that cash, right? Because their cash at beginning and ending of the period, their cash is relatively stable. I mean, it's not huge changes in cash. So where's the cash actually coming from? It's issuing debt. They are issuing more debt to buy back more shares. And that's because their share price has dropped about 50% in the last 5 years due to poor management, essentially. But they're still generating net income. They're still generating profits. And the bond market is still willing to issue them debt at the same or lower interest rates as the past couple of years. And so they made the strategic decision that they're going to issue more debt. They're going to buy back shares. That reduces equity. It reduces the amount of shares outstanding. And assuming that the interest rate is low enough, their earnings per share will actually increase because they're purchasing back shares. There's going to be less shares, and then that makes the business as a whole more valuable. And so it's a change in capital structure. And if you ever take a finance class, you'll learn much more about this, which is just the mix of debt to equity in financing a company is really important. We've gone over this in previous examples. If a company has more debt, less equity, it's more risk, but more returns to the shareholders if the business does well. And that's essentially the strategy that we can see playing out here, is that they had some repayments of debt, they had some more issuances of debt, but overall, they took out about 200 billion in debt last year and then paid it out as share buybacks and dividends in addition to their free cash flow. And so that means that they're recapitalizing. and having more debt and less equity. So that's sort of the stuff that we can see on a statement of cash flows. Another thing to look for is just make sure when looking at a company, if their net cash provided by operating activities is negative, something's going very wrong with the business, because if a company's bleeding cash from operations, it has to come from somewhere else. They're either going to have to issue more debt, issue more stock, or sell assets, right? There's three elements to this, and the cash has to come from somewhere and the cash has to go somewhere. And in the ideal world for investors, the cash comes from operations and it goes to financing activities. But in a startup, because a business is just starting out, usually the assets come from financing activities and it goes to, especially investing activities, sometimes operations, to get the business going. And so it can really tell us a lot about where is this company at? What are the challenges going to be to management in the coming years? And with that, so does anybody have any questions on that before we get into the mechanics of how to prepare a cash flow statement? Cool. So cash flows from operating activities are inflows and outflows from the day-to-day operations of a company. There's two methods, the direct method and the indirect method. However, they both result in the same amount of operating cash flows. It's just a different way of presenting it on the financial statements, and it's a different way of preparing it and calculating it. But the actual net cash flows from operating activities, exact same. And under the direct method, we list out every single item, essentially. Received from customers, paid for merchandise, paid for operating expenses, paid for interest, paid for taxes, net cash flows from operating activities. And so on the face of it, it's quite simple. In reality, it's extremely difficult or nearly impossible for a multinational corporation to do it this way, because there's just a lot of transactions and a lot of moving parts. And so to simplify things, the indirect method, we take net income and then we adjust net income for all of the non-cash items or cash items that did not affect net income, and then the changes in changes in current liabilities and current assets that are sort of in the operating activities category. For example, dividends payable. It's a current liability, but that'd be a financing activity because dividends are a financing activity compared to accounts payable. Changes in accounts payable impact operating cash flows because accounts payable transactions are regular transactions of the business, whereas dividends are for financing, they're payments to shareholders. And once again, note that the cash flows from operating activities are the same in both examples. So under the direct method, we have cash received from customers, cash paid for expenses to creditors, net cash flows from operating activities. However, in the indirect method, we start with net income, then we show our increase in accounts payable, which would be the increase. Accounts payable is to purchase inventory. And if our cost of goods sold is shown in our net income. Our cost of goods sold is already in our net income. And so if we have the beginning accounts payable, we assume that we paid that. And then the ending accounts payable still has not been paid. And so the change in the accounts payable impacts the net cash flows from operating activities. And if accounts payable goes up, that means we owe more this year. That means we didn't pay as much cash. That means operating cash flow went up. If supplies goes up, and in this example, I think it's only supplies, and if supplies goes up, that means that we paid more for supplies that we already have, right? But that didn't change net income. That has to decrease cash flows. And so that's the basis of the indirect method. And for investing activities, we show the inflows and outflows for long-term assets. And so cash inflows from investing activities and then cash used for investing activities. And in the homework, we'll just have a whole bunch of lines to it. So in the example I go through my homework walkthrough, um, we have like cash paid for purchase of land, cash paid for purchase of equipment, gain on or cash received from sale of investment. And it's all about the cash. For those three items, it's all about the cash. The gain or loss is irrelevant because all we're looking at here is the cash flow. And if there's gain or loss, that would show up in the net income portion, the operating activities, because we would have to back out any gain or loss from our net income because that did not impact operating cash flows. And then we would use the actual cash amount in the investing section. And say for financing activities are inflows and outflows for long-term liabilities and stockholders' equity. And they're reported as following on the statement of cash flows. So we have cash inflows from financing activities, cash used for financing activities. If you remember the Vail's financing activities section, the increases to cash were shown at the top. So the issuances of new debt, that was at the top. And then the repayments of debt, and then the payments of dividends and share buybacks is more at the bottom. And then we have net cash flows from or used for financing activities. And then we also have non-cash investing and financing activities, such as issuing common stock to retire long-term debt. For example, if it's convertible stock and a company, if it's a convertible stock and convertible bond shareholders, I guess, convert the convertible bonds from bonds into stock, that would be that sort of conversion. Or if they're in some sort of restructuring agreement because they can't make their debt payments, they could issue more stock in direct settlement of the debt without actually paying or receiving any cash. And although this transaction does not directly affect cash, it does eliminate future cash payments for interest when they mature. And because such transactions indirectly affect cash flows, they are reported in a separate section of the statement of cash flows. So, for example, if we go back to Vail, I don't know if they had any special transactions. It looks like they didn't have any special transactions. But note that the special disclosure requirements, cash paid for interest and cash paid for taxes at the bottom, are shown. And then they also had non-cash investing activities such as accrued capital expenditures. And that would be if they're a ski resort. If they're constructing new lifts, if they're constructing a new mountain. Remember when we looked into construction in progress? That all goes into construction in progress account. But there's accrued capital expenditures as a part of that. For example, interest on a construction loan could possibly be accrued into that. Maybe that's a non-cash expense for now, but we need to show that as a non-cash investing activity. If there was a non-cash financing activity like a convertible stock exercise or issuing stock to settle some long-term debt, that'd be shown in the non-cash section. It's just a little footnote at the bottom. And once again, operating, investing, financing cash flows, and they're always shown in the same order. And it makes it easier for everybody. And as we saw in Vail's financials, the non-cash investing and financing activities are shown underneath at the bottom, as well as any other disclosure requirements like cash paid for interest, cash paid for taxes. And cash flow per share is sometimes reported in the financial press. It's not allowed to be reported on the statement of cash flows, generally speaking. Companies can report cash flow per share. It's what's called a non-GAAP measure. Like if you've ever heard of EBITDA, interest before appreciation, interest before income taxes, depreciation, and amortization, that's a non-GAAP metric. No one's going to show EBITDA per share on an income statement. No one's going to show cash flow per share on a statement of cash flows, but it might be all the CEO talks about in the earnings call because that's what they feel most directly represents the business, and that's what their bonus is judged on, and that's what they can most easily manipulate, honestly. I mean, you can watch. I mean, there is some argument for using EBITDA as a way to judge management, but as a way to judge a business, in my opinion, GAAP accounting, net income, earnings per share is a good way. But you can use all these other metrics like cash flow per share or free cash flow per share or any other metric. You can use it to further understand the business and the investment. Cash flow per share is normally computed as net cash flows from operating activities divided by the number of common shares outstanding. However, it's misleading because it could be interpreted as the per share amount available for dividends or and it may be interpreted as the cash flow per share equivalent to earnings per share. It's also not standardized. For example, if we showed cash flow per share, we might think that that's net increase in cash per share or free cash flow per share. And because there's no standard for it, right? In this slide, it's net cash flows from operating activities divided by number of common shares outstanding. But wouldn't net cash flows from operating activities minus capital expenditures, free cash flow divided by shares outstanding be better, right? So it doesn't show on the statement of cash flows because it's not standard, it's not a GAAP metric. And if companies do show this somewhere on their financial statements, they just have a reconciliation in the footnotes. It's called reconciliation of non-GAAP financial metrics, and it shows how they calculate. It lays out all the formulas for how they calculate this stuff that they show in their earnings releases and the management discussion. And I find it really interesting to see what games they play, honestly. Like and the most common one, if you see restructuring expense in like an adjusted EBITDA, that's literally a CEO showing that, okay, this was net income. This is taking out all the depreciation and the interest. And then the restructuring expense is literally just the cost to lay people off. That's severance expense. 90% of the time, a restructuring expense is just severance. So now you know. And which of the following three types of cash flow activities, which is not shown on the statement of cash flows? Perfect. Selling activities are not on the statement of cash flows. And in a recent year, JCPenney's reported a net loss of $268 million from operations. However, the statement of cash flows had $428 million in cash flows from operating activities. How is this possible? Like, let's just consider for a moment how is it possible? Exactly. Depreciation and other non-cash activities. Depreciation, $544 million. That's exactly it. So, and it looks like they also had some other items too that were fairly minor, including a decrease in inventory of 271 billion, which is really striking, honestly. Like, I don't know what that means for the future of J.C. Penney in this. I don't know what year this is from, but in this particular example, if their inventory is decreasing by 271 million, that means they sold it and they got the cash for it, and so operating cash flows went up. What does it mean for them that their inventory is gone down so much? I don't know. Maybe they've gotten leaner and more efficient, or maybe they closed a lot of stores and net income might be less in the future. So that would be more investigation required. So now we have a number of transactions and we need to understand the effect on the statement of cash flows and how the homework is set up. We're either going to be given a balance sheet, which shows the beginning and ending balances of all these accounts, or a bunch of T accounts that shows the beginning and ending balances of all these accounts. And then we're going to be given a whole bunch of these transactions that we couldn't necessarily tease out by looking at the balance sheet alone. Because a statement of cash flows problem is essentially a big puzzle. And we're looking at the balance sheet, we're looking at this list of transactions and trying to fill out the statement of cash flows and praying that it that the statement of cash flows balances and it ties to our beginning and ending cash. And when it ties on the first try, you will never stop chasing that high again. I will just start with that. The, so first transaction, the company retired $400,000 in bonds. There was 3,000 of unamortized discount, and they paid 407,000 cash payment of 407,000. And so the impact to the statement of cash flows would be financing activities of the amount of cash actually paid, 407,000. And then we'd also, there's unamortized discount, which means that the carrying value of the bonds was $397,000, which means that there was a $10,000 loss on the retirement of these bonds. That would have to be taken out of operating activities. In the net income portion, there'd be an adjustment. We would increase our operating cash flows because we're recording this $407,000 in the financing section. And we want to make sure that we're not double dipping and that makes our cash tie at the end. And the loss on the retirement of this debt is not an operating cash flow activity. That's the key. That's what makes it correct to take it out of the operating cash flow section, and then we report the actual cash paid in the financing section. Sold 20,000 shares of $5 par common stock for 40 a share. So we take 20,000 multiplied by the cash, we get $800,000. If you're looking at this on a homework, and for example, it says sold common stock for cash, and it doesn't actually tell you the amount, you can look at how much did the how much did the common stock par value go up? How much did the additional paid in capital go up? And you can know how much cash did they receive for the common stock in the year. Like we can determine this from the balance sheet. And that's really important for this chapter, is to be able to look at the balance sheet and be like, why did it go up this much? And how much did it go up because of this? Because what accounts are affected, and how did this transact? Like thinking back, okay, what accounts are affected? What would the journal entry look like if this happened? We see how the balances change from year to year. Do you have a You seem like you were about to say something, so I don't know. Yeah, okay. Um, so anyways, now we sell equipment with a book value of 76,200 for 82,800. Um, so the cash receipt is 82,800, and that would be like a cash flow from investing activities that increase our investing cash flows. And then the gain the gain would reduce our operating cash flows under the indirect method because we have net income at the beginning, and then we have to take the gain back, and then we record the actual cash received as our investing cash flow. Purchasing land for 625,000 in cash is fairly simple. We just cash for purchasing land in our investing section, and it would reduce it. Make sure to note whether you should be using a negative or a positive number on the homework. Because in the example that I did this morning, it said if it's a cash outflow, use negative cash, or if it increases cash flow, positive. If it decreases cash flow, negative. In this case, this would be a negative number, 625,000, because it reduces cash. It's a cash outflow. It's cash paid for land. So just make sure to take a note of that. And purchased a building by paying 50,000 in cash and issuing a $500,000 mortgage. That's going to show up as cash payment of $50,000 in the investing section. And as sort of the footnotes, the non-cash activities section, we're going to see the $500,000 mortgage appear. So we're not pulling one over on the investors just because cash technically did not change hands. And sold a new issue of $400,000 in bonds at 99. We take $400,000 times 99% because bonds priced as a percentage of par at 99, that means 99% of par. So we know the par value of 400,000, the cash receipt value is 396,000, which is 99% of 400. And that's just going to show up. There's no gain or loss or anything that would affect operating cash flows. That's just going to show up in the financing section as inflows. And then repurchased 10,000 shares of common stock at $18.50 per share. Financing activity, cash outflow, $185,000. And then paying dividends per share, there were 1 million shares and 180,000 of treasury stock. And so we have to compute the actual shares outstanding because we don't pay dividends to ourselves. And so we take 1 million minus 180,000 and we get 820,000 multiplied by $1.75 dividend, and we get 1,435,000 cash paid for dividends in the financing section. I think we've gone over quite a few examples here, but net income is operating, cash for dividends is financing, common stock financing, issuing or redeeming bonds is financing, long-term investments would be investing, purchased patents, investing, sold equipment, investing, purchasing buildings, investing. So that's fairly straightforward. And now we'll get into cash flows from operating activities. And let's see here. So using the accounting equation, right? This is the algebra for the justification of the logic that we were using before, right? Where if accounts receivable goes up, that means that operating cash flow went down compared to net income because accounts receivable went up. That's cash we didn't get from customers. Inventory goes up, that's cash we had to pay for inventory. That's cash that's now in inventory, and that didn't impact net income. JCPenney's sold off all their inventory. That's an operating cash flow that is irrelevant to net income. So if we have assets equals liabilities plus stockholders' equity, and then we have cash plus non-cash equals liabilities plus stockholders' equity, then cash equals liabilities plus stockholders' equity minus non-cash assets, right? Because if we take cash plus non-cash, subtract the non-cash on the other side of the equation, cash is equal to liabilities plus stockholders' equity minus non-cash assets. And that means that if liabilities and stockholders' equity remain the same and cash goes up, if non-cash assets increase and nothing else changes on equity or liabilities, that means that cash decreased because money went from cash to non-cash assets, right? If money went from cash into accounts receivable or inventory. Also, if liabilities increase and the other two remain the same, that means cash increased. So if accounts payable goes up, cash goes up because we didn't pay our bill yet. So we have a bunch of cash and we have a bunch of short-term debt, right? That's a cash flow. So change in cash is change in liabilities plus change in stockholders' equity minus change in non-cash assets. So we have our balance sheet here for our income statement, right? We have 108,000 in net income. And then we have the increase or decrease in a lot of assets here. Note that accounts receivable. So cash increased overall 71,500. Accounts receivable increased 900,000. That's going to be a decrease compared to net income. Right, so we take our net income and we can see that in the retained earnings T account. So in the example where you're given all the T accounts for the business and not the financial statements, you can find the net income in the retained earnings T account. It's all about using the information that we have and solving the puzzle of how do we fill out this statement of cash flows. And we can also find dividends declared and share buybacks as well. Dividends and net income. So we have net income, it's 108,000. Using the accrual method of accounting, revenues and expenses, they're received and paid at different times than the cash. And so to get back to the cash, we kind of have to reverse all of the accrual accounting things that we've been doing all semester. And so if we think about all of the accrual, and this is why this is at the end, right? We've now gone through all of this stuff. This incorporates all of the transactions that we've used throughout the whole semester. And we have depreciation and amortization that's going to show up first. And then gains or losses on disposal of assets. Steps 1 and 2 are non-cash income and expenses, essentially. And step 3 is the changes in current operating assets and liabilities. So increases in non-cash assets, decreases in non-cash assets. So, if a non-cash asset goes up, like accounts receivable, operating cash flow goes down. If accounts receivable goes down, operating cash flow goes up. And I would take a picture of this, honestly, just so you can keep track uh, for yourselves, or at least write down some of the accounts, like assets go up, cash flow goes down, liabilities go down, cash flow goes up. It's just a really important relationship, and my brain, it is easily confused. But it makes sense when thinking about, like, what is this actually doing to cash? That's the key. So, oh, and then we have net cash flows from operating activities. So increases in non, we just got to go into some examples. This is ridiculous. So, for example, remember the accounts receivable increased, so that's a $9,000 decrease. The decreased inventory increased our cash flow by 8,000. The decrease in accounts payable increased our operating cash. The decrease in accounts payable decreased our operating cash flow because we had to pay it back. We paid back the accounts payable. And then the increase in accrued expenses, that increased our cash flow. And since the net, and then we also had income taxes payable, that's also an operating expense. And then we have net cash flows from operating activities. Note what's not included. We had the balance sheet here. What's not included in our increases and decreases is non-current assets and non-operating related assets and liabilities. For example, land, building, accumulated depreciation, not included in the comparison year-over-year changes. Income taxes payable included because that is, it might not be operating income or expense, but it is an operating cash flow of the business because it's not investing and it's not financing. Um, Dividends payable and bonds payable, changes of these, short-term or long-term, they're in the investing section. Interest payable, I could see interest payable being an operating, interest payable would be an operating portion one, because interest expense is in net income. That's part of our operating interest expense, especially cash paid for interest expense. That's an operating cash flow. But changes in bonds payable, dividends payable, that's financing activities. And it's because interest expense actually impacts our net income. Principal payments is actually raising money from bondholders, paying money back to bondholders. The interest expense is what actually impacts the net income of the business and the operating cash flows. Um, and then none of the equity accounts are included in this exercise either, because all of those accounts are related to financing activities. So, there's differences between um, the direct method and the indirect method. And, you know, the statement of cash flows it is meant to answer the question, where did you get your cash and where did you spend it? Did the cash come from operations? Did the cash come from financing? Was the company selling off investments? And then where did it use it? Was it investing in new business? Was it funding operations, or was it returning money to investors? And, you know, most of the time, the direct method is just considered inefficient to prepare. And it doesn't matter to investors so much whether it's broken out as cash received from customers, cash paid for inventory, cash paid for all these different items. When they're analyzing the actual operations of, like, where is the business making money, they're looking at the income statement. It's okay. Is the income statement expense mostly related to cost of goods sold, selling and admin expenses, and then they're looking at, honestly, really important is the segment reporting information. If you ever really want to understand a business, take a look at the segment reporting. For example, for Vail, they have different segments for their main resorts, and then there's sort of like Midwest resorts. And they also have different segments for their lift, like actual revenue from their lifts, revenue from the condos that they own, revenues from the restaurants that they own, revenues from the actual stores of like selling skis on the mountain. And and they'll break out in management's discussion, like what are their margins in each of their business. They have the 200% markup on their retail stores. That's in like literally a 70% gross margin on their retail ski shops, which is crazy. But look, that's where investors are actually looking to figure out details of the operations of the business. They're looking at this, where did you get your cash and how did you spend it? That's what they're looking at this for. And that's why it's not irrelevant whether the company uses the direct method or the indirect method from an investor's perspective. But generally, indirect method, because it's so much easier and less costly to produce those financials, that's what companies use. And investors either don't care or don't care enough for most companies to use the direct method. Because the direct method, I mean, it provides more details, it's a little bit clearer, but it's just way harder for big companies to produce. So, indicate whether each of the following would be added or deducted from net income for operating cash flows. So, decrease in inventory, that's an increase. Okay, we don't have. So it's the same exercise, but it looks like it's a different example. So we have a decrease in inventory that would increase our operating cash flow, right? And then increase in accounts receivable would decrease, increase in accounts payable would increase, right? Because we didn't pay the bill yet. Whoa. I don't know what just happened there. Um, yeah, depreciation increases, loss on retirement of long-term debt, that would actually increase, right? Because we want to reverse out that non-cash expense. So that would increase our operating cash flows because compared to net income, our operating cash flows are higher. And then that loss is going to be reflected in the financing activities because the financing activities will show the actual cash paid to retire the debt. Um, that goes the same with gain on disposal of fixed assets. The gain on disposal of fixed assets would reduce our operating cash flow because the gain would be included. The gain has to be reversed out of net income, and then we report the actual cash received for the fixed assets in the investing section. Um, and then net income and operating cash flows in this example are different because net income for the year was 106,800, and immediately we're adding back depreciation of 41,700, and then accounts receivable increased, and so that's going to decrease our cash flow, right? There's all these differences that result from accrual accounting, right? These are all timing differences. These are all journal entries that we made throughout this whole semester that reflect non-cash transactions that impact assets and then paying back those non-cash transactions. And that's the basis of accrual accounting. But then to go from net income to operating cash flow, we have to reverse all of that activity. And so I know, we've been going through this sort of one account at a time or one example at a time, and the statement of cash flows is so large. And so to get a full example, um, what I highly recommend watching my homework walkthrough video. It goes, it has a whole example of net income, operating cash flows, investing cash flows, financing cash flows. And I have it already recorded. I'll post it after class today. Um, Under the indirect method, if we prepare the statement of cash flows under the indirect method here, we start with our net income, and then we have to add back depreciation expense and then take away the gain. And then we have to adjust for each of the changes in assets. And so and excluding dividends payable. That's key to note, right? And so let's just take out the calculator here. So if we were going to calculate what operating cash flow is, we'd take 508,000, add 57,600, subtract 33,600 because that gain is not an operating cash flow gain. It's an investing cash flow. Accounts receivable increased by 8,960. So we have to decrease our cash flows because an asset increased. That means cash flow decreased. Then inventory went down, so we have to add that. Prepaid insurance went down, so we have to add that because that's an asset. So, and then accounts payable and income taxes payable are liabilities. Accounts payable went down, that decreases cash flow because we paid cash for it. And then income taxes payable went up, that increases cash flow because we expensed it without paying it. And so our and then dividends payable is ignored because that's a financing activity, cash paid for dividends. And so our operating cash flow in this example would be 525,410. So now we'll go over some of the investing cash flow activities. So the investing activities section reports the cash inflows and outflows related to changes in a company's long-term assets. And similar to preparing cash flows from or used for operating activities section, each change in the long-term asset account, we analyze it for how does the change affect cash flows from investing activities. For example, land, and we take a look at all of the transactions in each of these accounts, because if we took a look at the beginning balance and the ending balance, it wouldn't necessarily reflect the amount of cash actually in the transactions, right? Because sold land for so there's a $45,000 increase, no, decrease, $45,000 decrease in land from the beginning of the year to the end of the year. But there's more depth to it than that for the statement of cash flows because the land was sold for $72,000 on June 8th, and the credit to land in this T account, $60,000, which means that the land had a basis of 60,000, but the cash paid was 72,000. And so what's going to show up on our investing section is like proceeds from sale of land, $72,000. And then purchase like payments or purchases of land, $15,000 cash. So what's going to show up is the 72,000 and the 15,000 as $72,000 inflow, $15,000 outflow. That's what's going to show up on the statement of cash flows. The actual $60,000 decrease, not going to show up. The $12,000 gain, that has to be taken away from net income in the operating cash flow section. And then in the investing cash flow section, we show the actual cash amount. So we're not going to show, right? We're going to show gain on in the investing section, in the operating section, gain on sale of investments will be a negative number. It'll take away from cash flow. In the investing section, we're just going to show proceeds from sale of land, $72,000. We're not going to say proceeds from original basis of land, $60,000, proceeds from gain on land, $12,000. It's just going to be single line, actual cash amount, proceeds from sale of land, $72,000. And it's just going to show just as shown here, cash received from sale of land, cash paid for purchase of land. And the parentheses indicates a negative. And so, buildings and accumulated depreciation also impacts investing well, depreciation itself does not impact investing cash flow. However, purchasing for cash does impact. And let's see here. So yeah, once again, purchase of cash, balance of the initial building account, $60,000. That's what's going to go cash paid for purchase of building. The depreciation for the year is going to show up on the investing or in the operating cash flows portion as it's going to be taken out of net income. And that's also what's nice about recording buildings at historical cost is that if we know that there were no disposals of buildings during the year, and we take a look at the building account, the net increase is actually equal to the cash paid for buildings because we have 200,000 starting, 260,000 ending. Building was purchased for cash, $60,000. Of course, this can always be sort of messed up. If a building was sold during the year, then that would reduce the historical cost basis of buildings account as a whole. Or if a company had some non-cash ways to increase buildings, right? Then that would make it different than the actual change. So the key is to look at the facts presented in the problem and say, how did cash get impacted by this? And I'm going to stop there for today. Does anyone have any questions? Nope. Perfect. Thanks.